Hello everyone, Corey Mitchell here with TradeThatSwing.com, and in this video we're going to look at what most people don't know about trading rules. I see quite a bit of frustration and stuff, people not really understanding when a trading rule should be changed, if they're losing money, how long should they stick to a trading rule, how can you amend rules, are you even allowed to change them? How can we adapt but also follow our rules? You see lots of talk on, how traders need to adapt to market conditions. How is it adapting and following rules seem to kind of conflict for a lot of people? So we're going to look at, basically how those scenarios can play out and how we can have both. So you created or read about some rules for a strategy. The general consensus is that you should just follow them, right? Yes and no. Trading rules are a way to assess what is working. Basically, they are an input to assess profitability. That's all a trading rule really is if we do this, will it produce a profit or not? And then we can assess different rules versus other rules, right? You can create rules for this strategy and see, does this work? And then if that doesn't work, you can create different rules. That works better. And then we can create different rules and say, that works even better. So trading rules are just a way to assess what is working. And they potentially have the chance to, or the opportunity, they can be changed. They should be improved on over time. So that doesn't mean that we're just going to get infinitely better because conditions change. All it means is that if we notice that something's working a little bit better, we can alter our rules to accommodate that new information, our increased experience. This is how the world progresses, right? You learn something new and you create new rules and for it to embrace that new knowledge. So they should be improved over time. They're not totally static. If you might come up with a super simple strategy, and then as you're trading it, maybe it produces a bit of money, but you notice you know what? There's a lot of room after I get out. Like I could be making more profit. It's kind of dumb just to keep taking the same amount of money off the table if you realize that you could be making a lot more. Now there are some psychological things that play into it, and maybe you're very comfortable where you're at, which is also fine. But the rules, basically, they can be expanded. Whether we decide to actually improve them over time or expand them, that's up to us. But trading rules can be improved on over time. And I would recommend that they probably should be. It's also important to point out when you're dealing with trading rules, the exact same rules might not work for everyone. And this really blows people's mind. They're like, how can this person be so popular? Their trading rules, they don't even work. But your background knowledge, beliefs, attention to detail, and even vision can play a role in whether you can implement someone else's strategy. And this is why in all my courses, I have a section on, I basically lay out going through as much detail as I can think of on a strategy. But then I also have a section that says, hey, this is how you review trades and this is how you improve, so that you can look at your own trades and say, you know what, I took an entry here, but entering in this way might actually be a little bit better. I put my stop loss here, but I actually don't need it to be that big. I could probably reduce it a little bit. Or maybe I'm getting stopped out too quick. I need to expand it a little bit. I provide a roadmap to basically improve your own trades. And the reason I do that is because, there's the possibility that you just looking at my rounded tops, rounded bottoms, TCs, contraction patterns, all these patterns I trade, they might not sync up for you. You might look at them and say, you know what? I just can't see it, right? That's the common thing. I can't see it. It's not clicking. So a background knowledge also will play a big role, because I have a lot of information accumulated over the years which I incorporate into my trading, which I'm probably not even aware that I'm using. And the only reason I become aware of it is because people ask me questions and they're like, well, you say there's a sharp move up, a pullback, and then when it starts going up, you buy. But what if all there's like little wicks on those candles? Or what if it's a big wick? I'm just like looking at that chart like a picture, right? I'm just taking it in, processing it, and coming up with a decision. And some of those like minor details, I'm like processing almost subconsciously. I'm not even aware until I have to actually go in and dissect. And then I'm telling people like, okay, this is actually what I'm doing. But it's not, I'm not like actively thinking about it. It's just going on in the back of my head. But if you're new, you're not going to have all that stuff in the back of your head already, right? You do have to process it and you have to think about it. And so that's why I have the questions below, because I know that there's going to be things that I missed that I kind of take for granted, some background knowledge. Beliefs also play a big role. If you're taking a day trading course, but you actually think that day trading really can't work, you're really thinking like, you know what, I just wasted my money buying this course. There's no way people can make money every day in the market. What are the odds that you are going to succeed if you keep that belief? It's going to be a self-fulfilling prophecy of failure. So attention to detail, like we talked about, the little wicks, all that, on candles. A lot of, it looks very simple when you just look at a chart and someone says, well, I bought this and I bought this. But when you look at attention to detail, well, does this high over here matter? Does the fact that, the price fell very sharply, does that matter? Does the price, if it's moving up slowly or quickly, does that matter? Attention to detail plays a big role. And again, a lot of that detail for an experienced trader is going to be subconscious. So again, and since you're mostly going to be, I say this because most of you watching are going to be absorbing material from experienced traders who do a lot of things subconsciously. Like driving a car, when you first learned, there's a lot of stuff. I don't know if you remember it, I kind of vaguely remember it, but it's like you feel like there's so much to do and so much to know about, monitoring the lights in the cars and making sure, you put the blinker on and, all these things. But after a little bit, it's like totally automatic. Like you don't think about your blinker and when you change lanes having to turn like, oh, I got to turn my blinker on. It's like just, you start turning and you basically just flick it. A lot of things are just automatic. And the same thing happens in trading, right? A lot of things become automatic. And that's the point you want to get to with your rules, right? Where they become more automatic. So I just say that to make you aware that ask questions. If something is unclear, ask questions, because maybe they just are doing something subconsciously. It's already in their background knowledge. Maybe they didn't think it was important, but it very well could be important to you. And that's why the exact same rules may not work for everyone, because they aren't clicking, they're not seeing maybe something the person knows and forgot to mention in the rules or in the write-up for a strategy or something. So yeah, eventually maybe it could work for you. But again, beliefs, all that attention to detail, maybe even how good your vision is, could affect things. So we can add in rules or modify existing rules based on experience. That's the takeaway. A rule, like we said, there's current trading rules. What's working? What's profitable? That is our current, basically how we assess the profitability of this certain set of standards, and then we could change those standards or rules to see, could we be more profitable, less profitable? We can develop totally different rules for new strategies. So we're not limited. I guess that's, if you get one takeaway from this video, it would be like, your trading rules are not infinite. They are for right now, and they can change, and they should change, and they can adapt, and they can be modified. And we'll talk about how to do that over the course of this slide. But yeah, they're not forever. They should change and they should adapt. I wouldn't change every trade. A little bit of common sense here. Just because you had a losing trade doesn't mean the concept for a strategy is bad. But we'd want to review, quite a few trades and get a sense of what would work better. And then you can test it to see, is a new way of doing things, would it have been more profitable than an old way of doing things, right? So you have your old results based on your old rules. If you were to tweak your stop loss a little bit, maybe reduce it or make it a little bit bigger, would that create a bigger profit? Because some of those trades wouldn't get stopped out maybe, or maybe you increase it, but that means bigger potential losses, possibly smaller reward to risk. Everything has a bit of a trade-off. So it's good to don't just assume that something's going to work. Actually go in and look and say, if I implemented this, how would that have changed those results? And then you can get a sense of what works better. You'll have some actual data. And then if something does seem to work way better, then you can implement that. One thing about trading rules is context often gets lost. So people have a tendency to only really look at the entry rules and maybe a little bit on the stop loss and target. But their main thing is like, how do I get in? How do I get in? Where do I get in? What do I get into? They just want to get in. That's a bit of a problem to begin with, right? Because we're setting ourselves up to see what we want to see. When we're very eager to get in, like the old analogy, everything looks like a nail when you're a hammer. The same thing happens in trading. If you're super eager to get in, you're probably going to end up over trading. But that's aside from the point. But trading isn't just about entries. It's about context. Context matters. And I have rules for context. If I am buying a stock that I'm going to be holding overnight, I need market conditions to be good, basically uptrending. And I have rules that describe what an uptrending market is. And those have to be in a good place in order for me to hold trades overnight, basically swing trade stocks. If I am day trading, I need to have enough movement. I may skip a trade if there's certain conditions. So like, for example, my TC strategy. It's a very simple, like, let's say we have a strong move up, we have a small pullback relative to the up move, and then we start moving up again. And I'm looking, like, basically once that pullback starts, as soon as the price moves above a candle high, I'm using that as an entry. Because I'm making the assumption that basically we had this strong move up, and it's not so much an assumption because it's based on thousands and thousands and thousands of examples of this that you can look on any chart and see. But strong run up, pullback, at least again, if you're looking for the conditions, you can find thousands of examples of it working if you look for the right conditions and context. So that strategy, and I'm buying as the price moves above the candle and expecting it to run, and so that's a very simple type pattern. But context matters. If there is the day high right above the entry point, I probably won't take it, just because that just throws a little bit of a red or yellow flag, let's call it. That day high, the price had got rejected. Those are often kind of stumbling points based on what I've seen in my experience. So yeah, the price might blow right through it, but quite often it kind of gets stuck there and wobbles around. So, I'm not as keen on taking that trade as one that has room, I call it. So maybe it's just coming off the day low. We had a really sharp move up, which indicates a change in trend. We get the pullback. We have lots of room up toward any kind of major swing highs or anything. That price has room to run. So that trade I'm going to take, whereas the other one I'm not. If I see a TC but overall movement's really low, I'm probably not going to take it. So context matters. There's the exact same signal There are times when I will take it, and there are times when I'm not. Times where I won't, because of context rules. And yeah, context rules are simply what's going on around the entry rule. So this means you can have different rules for different situations. One time you take the trade, one time you don't. Because in one situation you have a yellow flag, I call it, whereas in another situation you don't. In one situation you can take the long trade because market conditions are good. In another situation you can't take that long trade signal because market conditions are bad. So I factor for market conditions, which we just discussed, but I also will factor in and create rules for my mental state. So I have rules that basically allow me to consider how I'm feeling on a certain day and adapt to that. And this is important because even if we have a pre-trade routine, some days I feel better than others. Some days I'm more anxious. Some days I'm more eager. Some days, it's just going to vary from day to day based on what's going on in your life, how you slept, how you ate, a whole bunch of different things. So I'm not the exact same person every single day. So I create rules that adjust for that. If I'm a little anxious, I'm allowed to use a trailing stop loss, even though technically my strategy says, I should be holding for 2R, 3R, or whatever the strategy says my profit target should be. If I feel I cannot stick to my profit target, then I will use a trailing stop loss. And I have a certain trailing stop loss that I use that I'm allowed to use. And I basically decide that before I start trading, or even on the trade, I can say, you know what, I feel weird. Like, I'm going to be really upset for some reason. Sometimes this happens, like, especially toward the end of the day. I'll give you an example. Let's say I've had a good day. I'm up like 3, 4R or something. And, I feel like I've traded pretty good. And it's getting toward the end of my trading time, and I see one more setup. And so you have a choice there, right? Do I take that trade? It's like kind of right on the cusp of when I usually stop trading. So like a typical rule of like, you have to take it. If it's going to ruin the rest of my day, I have the flexibility to decide if I want to take that trade or not, right? If I lose on that trade and it cuts into, a really nice day, I may not. Or I may decide, I'm going to use a trailing stop loss on it because I don't want to get like 1R or 1.5R in the money and then just have it collapse on me and I end up, losing 1R or something. And yeah, then I feel kind of crappy. So I'm aware of my own feelings, and I'm not a robot. I don't believe that anyone is, even if they say they are. And so, I feel impacted by my trading and my trades. So I account for that. And I think most people should who are not robots. If there are robots out there, people who have zero emotion while trading, good for them. I actually view emotion while trading as a good thing because you can use it to gain insight into your trading. You can use that emotion to see when, I have a video on this, the psychology of price action, because you can use your emotion. If you're feeling like, oh man, like this is going to be bad, what do you think most other people are feeling who are in a similar situation? So that can give you insight into price action and what's potentially happening if we use it to our advantage, as opposed to, we kind of shun mental states like, oh, we're anxious, we got to get rid of that. But I say, hey, tune into that anxiety. It might be telling you something. And then we can also just simply create rules to adapt to our emotions. If we're feeling a little anxious, hey, use a trailing stop loss. There's no pressure to have to do something. So this comes into, or kind of plays into this idea that you can also modify your rules based on your current skill level. And we could also add in here at the end, or your current mental state, right? Because we might have a really high skill level, but maybe our current mental state isn't quite there. Like we've had a really rough week. Maybe something's going on with the kids or the partner or something. Death in the family, anything, right? You might not be at your peak mental state. So you can have rules that allow you to modify your rules for your current skill level or your current state, mental state. So the idea of this, at least with the skill level, is that we move incrementally toward ideal from where you are. So we're going to start at basically where you're at. What are you comfortable with doing? And even though that might not be what Corey said you're supposed to hold to a 2R target, but my mind's freaking out as soon as I get a little bit in the profit. Hey, go with from where you're at. Take that profit when you start freaking out. At least you made something. And then we can work on incrementally improving from there. With a mental skill level or your mental state, it's more about, you can kind of go back and forth. Like, I'm not in a good state today. I have rules that, maybe I trade a smaller position size, or I can use the trailing stop loss. And then once my mental state's good, I can bounce back to my, normal trading rules. But yeah, so this is the example of, skill level. So in my Euro USD day trading course, stock day trading course, we have profit targets, which are around 2 to 2R for most of the strategies. That just means, let's say you're risking $100 on a trade, or you're willing to lose $100, you're going to be making 200 or 250. Willing to lose 1,000, to be making 1,000, 2,500. So this is what we call R, basically. What would we say? A multiple of your risk. So whatever you're willing to risk, that's your R, and whatever multiple you make on it on your profits, that is your R profit. So let's say, 2.5 is kind of what Corey says you should be getting to, but you lose your mind once you're 1R in the profit, because you just start thinking like, oh man, like I'm in a nice profit right now, I don't want to lose it. And once you get into that kind of state, you're more likely to start making mistakes. The price wiggles around a little bit and you like freak out, and even though you shouldn't do it, you hit your button to exit. You exit at 0.5R, you could have had 1R. You exit at the worst possible point, or it pulls back all the way to your entry and you exit, and then it goes right back up to 1R or 2.5R, and you're just freaking out. It happens. So start with where you're at. If you start losing your mind a little bit once the price is 1R profit, take your profit at 1R. Or at worst case scenario, like put your stop loss like right there, maybe, and then if it keeps riding up a little bit, you make a little bit more, and just just cram your stop loss up against the rising price. Then at least you get that 1R, because your mind's already not in the right space, right, to really fully implement that trade well. If the price wiggles around, you're probably going to mess it up. So do what you got to do right now to lock in that profit. Notice that point where your mind goes a little haywire and say, you know what, that is my current threshold. That's my comfort zone right there. Then we can work on incrementally expanding it to get you to where you need to be. So if you start taking profit at 1R, then the next week, if you're day trading and you were profitable last week, then you can bump it up to 1.1R. And the next week, 1.2R. Or maybe if you weren't even profitable, but you traded well, right? Because now the strategy's changed a little bit, right? You have to win a lot more only making a 1R profit versus a 2.5R profit. You could think of it as, again, like you're risking 100 to make 100 right now, whereas ideally we're risking 100 to make 250. So you might be profitable if you had held to 2.5R, but since you're only holding to 1R, maybe your win rate was only like 30-40%, which at 1R you lost some money. But if you would have been able to hold the 2.5R, you would have made money, right? So if that's the case, if you would have been profitable holding it to the bigger target, Then maybe next week you bump it up to 1.1. And then if you still trading well, you might not necessarily be profitable, but if you had the bigger target, you would have been profitable. Then you bump it up to 1.2. The idea is that you'll eventually get to where you need to be, but you'll do it without blowing your mind. And the problem is that if you try to make that jump too quickly, if you lose your mind at a 1 hour profit target when the price is just started to move up, then it's going to be very hard to just all of a sudden one day be, oh well, I don't mind holding it to 2.5 hour. That's not going to happen. What's going to happen is you're going to get frustrated. You're going to abandon the strategy before you even get good at it, and then you're going to go to something else, and the exact same thing is going to happen. And you're going to have to make some leap you're not comfortable making, and you're going to abandon it too. And then you're going to find something else, and you're going to abandon it too, because you're making leaps that you cannot make. Your current skill level does not allow you to make. A little bit of history on these is that a 2.5 hour target was not some magical number. It's basically what I worked up to. So, I kind of started out I kind of liked being around a 1.5 hour initially. Like that was kind of my comfort zone. And then I found I could expand that out a bit. There's room after I get out for potential profit with my methods, so they can bump up to 2.5 hour with some. Some can even bump up to 3. But I tend to be comfortable around that 2.5 R. With the stocks, I do find 2 R is about what I can get out of my trades. Occasionally a little bit more with a trailing stop loss, but 2 R's often about as much as I can get. So I kind of found that sweet spot, right? But I started out smaller, and you might need to as well. And that's okay. The same thing happens with risk per trade, and this is discussed in the courses that I offer, because we want to get up to where we're eventually risking an amount that we're comfortable with. That might be 1% of our capital per trade. That does not mean we only put 1% of our capital into a trade. It means we are risking 1% of our capital. That means we could be putting all our capital into a trade, but if we end up losing 1% of our capital, we're getting out. But when you're starting out, you don't want to start at the end point. You want to start out small and then work out if you are profitable. So it's the same thing. Start at where your skill level's at. Don't be risking a big chunk. 1% of your capital might not seem like a lot, but new traders can easily lose 10 or 20% in a very short amount of time if risking 1% per trade. Whereas if you risk 1.1%, then you're only down 1 or 2% on your capital, because you're risking a fraction of what you were. So this is a better way to go, and then just work up. You'll eventually get there, but at least you'll be going through a good process. And even with this, with the smaller R's, you might notice you start making money quicker, right? Because you might get to that about maybe 1.5 R, and all of a sudden that balance flips, and it's whoa, I wasn't making money at 1 R, but now I'm starting to make money. And you did it a lot quicker than if you tried to make the jump to 2.5 R. At least you'll be making something. You can even have rules that allow for flexibility. So I'm not saying this one is for everyone, but kind of like I talked about before. I have rules for flexibility. If my mental state's not really great, I can use a trailing stop loss. But I do have other rules that allow for if something exceptional is happening, I notice a pattern just playing out over and over again, but it's not a typical entry, I'm allowed to trade that. I have trading rules that say, you know what, if you see something and you think it's a good opportunity, you are allowed to take it, with the condition that you still use your risk management, you still use your checklists, and you're still commentating. All those still apply. So if I'm day trading and I happen to notice the price just going back and forth between 2 points, a big battle between maybe 2 big buyers and sellers or something, and I can hop in and make some profit, get in here, get out there, and it's just happening over and over again. Sometimes it might last 30 seconds, sometimes it might last an hour. I can trade that. There's also been times I noticed a specific stock I was trading, it had a big sell-off at the exact same time every day. Like an algorithm came in and it was like, I think it was like 9:41 something. So like about 11 minutes after the market, and the stock would always kind of like creep up and then just like boom. And if I notice that, I can trade because it's like there's just money out there, and I'm going to take it. But I still have to use my risk management protocols. I'm, typically for day trading, if I lose 3 in a row at full position size, I'm done for the day. Or I could split up my position size, but I'm like capped at a certain amount I'm willing to lose a day. That still applies. I still have to go through my checklist. Is this a good risk reward situation? Is this, can I get a good entry? Where will I going to put my stop loss? Where does my profit target go? How am I going to manage that trade? That's where the commentating comes in. How am I going to manage this trade? If it ends, how am I going to know? And what am I going to do? And the answer to that is, well, if I start to notice the pattern not playing out anymore, that's it. I'm done. Go back to my normal stuff. So all those things have to apply. And it's basically just, if I want to risk, one trade on this, I am allowed to do that because extraordinary situations do happen in the market. They don't come along very often. But if they do, I want to be there to take advantage of them. So the whole takeaway of this is that trading rules are not some external thing that are bestowed on us that we have to follow. They are not permanent. They are not forever. They are trading rules, as we mentioned at the beginning, are simply our current method for seeing if something works or not. Or basically how much money we can make. That, rules just allow us to see what's the profit potential. And trading rules can and should be improved on over time based on our experience. Trading rules are contextual, which means we should have rules for context. They should be adaptive, meaning we should have rules that tell us when we can adapt, maybe when we can't. And yeah, they should change based on your experience and the information you accumulate. Check out TradeThatSwing.com for loads of insights on trading. Please do like, share, and subscribe this if this was something you enjoyed. This type of information isn't often discussed. It's kind of like getting into like the little details that are often glossed over. It's not discussed very often. So if you like it, let me know. If you have ideas for other things you'd like me to discuss, let me know that as well. And happy trading.